Very good evening and welcome. You're watching live session on the economic outlook for India, powered by Investonomics, an initiative by ICICI Securities. Those of you who are watching us live, please do subscribe to our YouTube channel and also post your queries in the comment section below. We will try and take some of your queries and questions towards the end of this session. To begin with, the US is in turmoil as far as the economy is concerned and the banking system is concerned. There has been a lot of talk on who is to blame for the SVB financial crisis and collapse. The first big casualty of aggressive and rapid rate hikes and tighter monetary policy. But one thing seems quite clear, that we most likely are approaching peak as far as the interest rate cycle is concerned. What are the next steps? Will there be contagion effect? How safe are Indian banks? And how isolated is Indian economy? To talk on this and much more, joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Very good evening, Mr. Basu, and thank you so much for joining in.
Good evening, Gitu, and welcome to the audience.
So headlines are changing fast, with no one having a clue of what would hit the wires next. Let's start with the crisis that we are seeing in US. What went wrong as far as the SVB bank and the Signature Bank is concerned, and who is to be blamed for this crisis? Can we say it's a repeat of what we saw in the 2008 global financial crisis?
No, this is not like the global financial crisis. First of all, I don't like to call it the global financial crisis because that crisis basically hit the US and Europe, not Asia. Not India, not China, not most of the rest of Asia. So it's not really global. Whatever happens to them seems to become global, but it's not global. So you could call it the Western world financial crisis of 2008-9. That was a very severe crisis. It led to almost a complete collapse of the Western world financial system. This time around, it's a much more contained problem. Of course, there's been a bank run, which is a very unusual event. Before the 1930s, bank runs were quite common in global capitalism. But after the steps that were put in place during the Great Depression, bank runs had become much less commonplace. But this time around, we've had a bank run. We've had basically a panic. And I think part of the reason why there was a panic in the US, where 3 banks have collapsed as a result of that panic, is that the United States had withdrawn reserve requirements altogether. On the 26th of March, 2020, the Fed announced that reserve requirements would be brought down to 0 from 10%. Now, reserve requirements are the first line of defense, first line of liquidity defense that banks have when they face problems of liquidity. And of course, banks always face liquidity problems because a lot of their liabilities, deposits and so on, are fairly short term, and they lend for the longer term. So there's a natural duration mismatch between liabilities and assets. So to deal with that, banks typically hold reserves. So there were statutory reserves in the US of 10%. They had to hold, all banks had to hold 10% of their deposit base as cash reserves at the central bank to be called upon in times of stress like we had a couple of weeks ago. But those reserve requirements were cut to 0. And at that point, it didn't result in any major headlines. Most banks in the US had excess reserves, well beyond that 10% limit. But the whole point of that of a reserve requirement is that it gives you a buffer. Once you remove that buffer, then the possibility of a bank run and being unable to deal with it rises. So that is essentially what happened with Silicon Valley Bank, and before that, it had already happened to a small bank called Silvergate Capital, and then thereafter it happened to Signature Bank in New York. So there were two San Francisco area banks that collapsed basically because of bank runs, and then Signature Bank. So we had three. Actual problem with Silicon Valley Bank is now quite well known. Basically, what happened is that during the year 2020, all individuals in the US were given blank checks by the government. Government gave them so-called stimulus checks to deal with the potential loss of jobs, etc. Now, the loss of jobs and so on really lasted only 2 months. But these stimulus checks kept coming. There was one set that came in 2020, another set that came at the end of 2020, and then another set that came in March 2021. So there were 3 sets of stimulus checks that came in, and that's one set. The other is that some companies, particularly those that were dealing with things like Zoom and Microsoft Teams and related software and private equity type companies, were seeing a lot of cash inflow because their business was booming during the COVID crisis. And so they placed a lot of deposits. They and also individual depositors placed large deposits at a bank like Silicon Valley Bank. And Silicon Valley Bank made the mistake of using these excess deposits to invest in long-term government bonds and to buy mortgage-backed securities. Now, they did this primarily in order to improve their returns. So a bond pays much more than a treasury bill. A treasury bill will probably pay you, close to zero, maybe 0.25% at that time. So treasury bills pay you a very low yield coupon, whereas bonds pay you much higher coupons. And so they got a little greedy. They bought long-term bonds instead of placing short-term deposits in short-term instruments like treasury bills, which are less than 1 year in duration. And as a result of this mismatch between liabilities and assets, they eventually ran into trouble. The trouble really started once interest rates started rising last year. Once interest rates began rising, the value of the bond portfolio began to decline, as it always does. So rising interest rates reduces the value of longer-term bonds. So that happened partly because the Fed was promising, was promising until the last quarter. In fact, not just last quarter of 2021, but even in January 2022, at its meeting, they were saying that they are not going to be raising interest rates until 2024. So banks like Silicon Valley Bank acted upon that so-called promise, and didn't reduce duration as they should have before interest rates started rising. And so what happened at the beginning of this year is that Silicon Valley Bank found that it has a liquidity issue because a lot of their assets are longer term, and so they tried to sell some of those assets. That was a very foolish decision. Those assets should in fact be held to maturity. Had they held to maturity, they would be fine. Instead, they should have offered that as collateral to other banks and even to the Fed. They could have offered these assets as collateral to the Fed and said, please lend us some money. We have a little bit of a liquidity shortage at the moment, so we need money. Please take this as collateral, hold it on your books, and give us some liquidity. Instead of doing that, they tried to sell the assets. They sold $21 billion. They had a total of $91 billion of these long-term assets. They sold $21 billion worth, and they made a loss of $1.8 billion on that sale. That is a bigger loss than all the profits of the previous 10 years or so. And once this became known, depositors began to worry that their bank is in trouble. And they began to withdraw deposits, and so you had a bank run. Now, this is not going to happen in India for the simple reason that in India, there is a reserve requirement of 4.5%. It's not a very high reserve requirement, it's 4.5%. But in addition to the reserve requirement of 4.5%, India also imposes what is called the statutory liquidity ratio. All banks have to hold about 18% of their deposit base in government bonds. And these, of course, are perfectly liquid. You can always sell some of your bonds. There's a price at which you can sell them. So this is, the total liquidity is 22.5% that is available to a bank at all times, which basically reduces their riskiness hugely. And of course, it also means that the returns that they can generate are reduced because you're holding a large amount of your deposit base in a so-called cushion of safety. So that cushion of safety is, looks really good at times like this. In a time when you have a crisis in the world, then that cushion of safety looks really a very useful thing to have. But it also means that your returns that you can generate are a little bit reduced. Whereas Silicon Valley Bank generated terrific returns in the last 2 years, paid some of those returns to shareholders, and a lot of it to senior managers within the bank itself. They got paid very well in the last 2 years, and now that bank has collapsed. So that's the nature of it. And of course, this is not over. The banking crisis in the Western world is not over because there is great uncertainty about what will happen to other banks. And no one really can say whether there are banks like these three banks that might have similar problems on their asset side and similar asset liability mismatches. And given that uncertainty, markets are selling off. So today, there's been a big sell-off in Deutsche Bank, the largest bank in Germany. It's ironic because at the time of the last so-called global financial crisis, or the Western world's financial crisis of 2008-9, two of the banks that survived that very well without needing government support were Credit Suisse and Deutsche Bank.
Right.
But typically, if you do well, in these financial markets, if you do well in one financial crisis, you're likely to be in trouble by the next one. So UBS, ironically, needed an injection of capital from the government of Switzerland in 2008-9. And now, of course, UBS has just bought Credit Suisse, and there's a great deal of hubris around UBS. But someone should remind them that just 15 years ago, they were actually the ones that were in trouble. So Deutsche Bank, ironically, then run by an Indian. It was then run by an Indian called Anshu Jain, the late Anshu Jain. And it sailed through that financial crisis. But by 2012, Deutsche Bank was in trouble. So similar to Credit Suisse. I mean, Credit Suisse sailed through that crisis, the post-Lehman crisis, but then got into trouble by 2012, 2013, and has been in trouble ever since. So we still have a great deal of panic and uncertainty in international financial circles. But what is interesting to note and worthwhile noting is that we are seeing sell-offs in the share prices of these banks, but we're not seeing a run on the bank deposits. So you saw that with First Republic. First Republic Bank is a slightly bigger bank than Silicon Valley Bank, but it has many of the same characteristics. It looks very similar in terms of its assets and liabilities, and it had some of the same potential problems. And so initially there was a run on First Republic Bank as well, but the US announced that all deposits at the three troubled banks would be made whole. All depositors would be made whole, which actually created what I call moral hazard. Moral hazard is basically if the government comes and rescues you when you're in trouble, then in the future, bankers are going to be more imprudent. They're going to be, they'll know that if the government can come and rescue us, why should we why should we be so risk averse in our asset liability management? So so that's a bad thing, the fact that they extended the deposit guarantee to everybody. But what is subsequently with First Republic Bank and others, the government has encouraged a private sector solution. It has stepped away from providing a blanket guarantee on deposits. So, but with First Republic, what's happened is that JP Morgan and a few other the large banks got together and placed $30 billion of deposits at First Republic Bank as a show of confidence in that bank. And that has at least ensured that there's no further bank run. Depositors are at least reassured, but there is no respite in terms of share price falling. Share prices of First Republic remain under pressure, as do those now of Deutsche Bank and several of the banks around Europe. And part of the reason, of course, is that this week has been a very interesting week in terms of monetary policy. We've had the US Fed raising rates by 25 basis points. Soon after that, the Bank of England followed with a 25 basis point hike as well. And most interestingly, the Swiss National Bank raised its policy rate by 50 basis points yesterday. So despite the fact that you had this problem with UBS having to buy Credit Suisse, the second biggest Swiss bank, the Swiss National Bank went ahead with a 50 basis point hike. Now, this is really significant because the policy rate in Switzerland went from 1% to 1.5%. That's a really big shift. Just a year ago, the policy rate in Switzerland was minus 0.75%. Now, minus, it's very difficult to get your head around the idea of a negative interest rate. So, when normally you have an interest rate, when you put money in the bank pays you interest. But if there's a negative interest rate, when you put money in the bank is not paying you, you are paying the bank 0.75%. You're losing 0.75% a year by placing money there. So it's a very unusual situation. But it only occurred because there was an excess of liquidity in Switzerland. Now, the opposite of what was happening now. But the point is that since central banks are continuing with rate hikes, despite the fact that you've got these problems in the banking system, that is telling us that the central banks continue to be focused on the inflation fight. And the inflation fight is really quite a tough one because inflation everywhere in the world is above the target rates. So in the US, the core PCE inflation target is 2%. They are now at 4.7. In Europe, again, CPI inflation target is 2%. They're at 8.5. In the UK, it's 2%. They're at 10.4. In Switzerland, it's 0 to 2%. They're at 3.5. So all these countries have excessive inflation.
So that was a story of the crisis that the US is facing. But what about India? I mean, India's, as far as the regulatory framework of Indian financial system is concerned, it is very strong. We have, as you mentioned, we have a capital adequacy ratio, we have CRR, we have SLR. But the kind of rub-off that we have seen because of the negative sentiment globally in the financial markets, do you think that impacting the banks in India?
No, I don't think it impacts the banks very much. There isn't much counterparty exposure for the banks. So now the important thing about the banks in India is that they have been if anything, excessively prudent over the past 9 years. So this year, of course, credit growth is around 16%. So this year we've got good credit growth, and that pickup really started around July. It picked up much more in September. So over the last 6 to 9 months, there's been a very clear pickup in bank lending growth. But that followed a period of 8 years during which India's bank credit growth was just averaging 9% a year. Very, very modest credit growth over that period. So banks are now in a very good position relative to most of the rest of the world. They have ample liquidity, and they are well positioned to grow their credit at a time when most of the rest of the world will not be able to do that. So that actually is giving India some cause for happiness, in the sense that we're going to have better economic growth as a result than most of the rest of the world, and the banking system is in fine fettle. The only sector in India that will probably suffer a little bit is the IT sector. There are a lot of Indian software companies that are very dependent on what is called the BFSI sector, banks and financial service institutions and insurance companies as very important sources of business for them, and that will there'll be some impact on the growth of their revenues. But what I also note is that we are now in the midst of the strongest growth in India's services exports in at least 15 years. This in the current year to date, fiscal year to date, that is from April last year onwards, the growth in services exports is 30.5% year on year. That's a spectacular increase. Previous year growth was around 21.5%. So you've had 2 consecutive years of spectacular growth in services exports for India, and there'll probably be a little bit of a setback from the banking crisis in the Western world, but nothing that will be too catastrophic. In fact, I think one of the reasons for why services exports are doing so well is because there are tighter immigration controls being put in place in the United States and in Western Europe. As a result of which, Indian software workers aren't getting the normal work visas that they would get in the numbers that they would normally get. And since they aren't getting them, the work is being done offshore in India. It's being done in India by the same professionals who are doing it at their desks or at their homes in India, rather than sitting in their clients' offices in the United States and Western Europe. And so we're seeing a boom in exports. That's one. The other aspect is that we're seeing a continual increase in the complexity of work being done by Indian software companies. They are increasingly becoming like consulting companies, competing with the likes of Accenture and IBM and so on, at the high end of the information technology food chain, so to speak. And from that point of view, you're beginning to see, a transformative change in India's services exports.
Mr. Basu, how do you see future policy action panning out, as Powell indicated further banking-related credit tightening?
Well, what is in terms of the tightening of policy, I don't think that the Fed can stop raising rates anytime soon. So I was in a minority saying that the Fed is going to raise rates 25 basis points at this meeting. And I think that, the Fed was very clear. They said that they are going to be raising at least another 25 basis points. The interest rate that the FOMC members themselves predict for the end of this year is another 25 basis points above where it is currently. So they themselves are predicting that there will be at least one more rate hike of 25 basis points. Mm-hmm. I think we have to take that as given. At a minimum, there'll be one more rate hike, perhaps even two.
Okay.
Now, whether the rate hikes will happen within 6 weeks, or the first rate hike will happen in 6 weeks, is still slightly questionable. I mean, if there is a lot of so the Fed pointed out that there's a natural tightening of credit conditions as a result of the problems in the banking sector. Mm-hmm. So what that basically is telling us is that if there's a natural tightening of credit conditions, then the economy will slow down even more than it would otherwise have. Okay. And if that happens, then inflation will begin to wane on its own because the recession starts pretty quickly. The recession proves to be a bit worse than expected in the early stages, and that creates slack in the economy. It helps the unemployment rate to rise, and as that happens, you begin to see inflation moderating, wage demands moderating, and wage settlements moderating. So all of that will contribute to helping the Fed fight the inflation fight through other means other than raising rates. So yes, a lot. I mean, there's a bit of uncertainty about whether or not the rate hike will come at the next meeting itself or will come in 3 months' time. But I think at least one more rate hike is almost certain from the US. And in Europe, unfortunately, there's so much room to raise rates further. Inflation is way above their target. And if inflation is that far above the target, then the ECB has to keep raising rates. It's been very behind the curve. And so it has to continue raising rates. So I think that is still to happen. Now, with regard to India, we've had a bit of an inflation shock in India as well, or at least the numbers suggest that there was a negative surprise in that CPI inflation in January was 6.52%, and in February was 6.44%. So we've had a couple of bad months after significant moderation to below that 6% level in November and December. In December, the number was 5.72. Most of us expected that inflation would continue to moderate in January and February. Instead, there was a jump. But the jump was quite unique in that the jump was largely on account of a big spike in wheat prices in particular, and also rice prices. Now, rice prices were expected to pick up because part of the rice harvest was damaged because of unseasonal rainfall towards the end of the monsoon and immediately after. So during the harvest period in October, there was the standing crop in many parts of North India was destroyed or was partially damaged because of unseasonal rains. So yes, with rice, it was expected to happen. But the real surprise is that wheat prices have increased much more than rice. Wheat inflation is around over 16%. Rice inflation is just over 10%. So it's this which is causing the problem. But within that, there's actually another factor at work. And that is that from January onwards, the government is distributing rice and wheat to 800 million people across the country, free of cost. So this free food grain distribution to 800 million people is actually, that what that means is that people are getting a key item of consumption for zero cost. Now, in the CPI, unfortunately, the CPI manual for India does not have any scope for zero prices. If something is given free, it is not it gets eliminated from the CPI calculation. Okay. So this is a problem in other countries as well. Zero priced items are difficult to deal with. But in India, it's gone from a non-zero price to zero, and that should be reflected in reduced inflation. But in fact, it isn't, because the zero prices are not being counted at all. It goes out of the index altogether. Mm-hmm. And also, if 800 million people are getting rice and wheat free, then that accounts for most of their rice and wheat consumption in the country. So that should somehow be reflected, but it's not. So I think that the rice and wheat inflation numbers are very exaggerated, but unfortunately, it's there. It's not going to go away, because this is a statistical artifact that is still there. There's been an RBI paper on this that was just published a couple of days ago that acknowledges this problem. So I think that at the next RBI meeting, which is just over 2 weeks away, 6th of April, the RBI will have a difficult decision. And I think that they are going to choose not to raise rates, because the actual inflation, they recognize that the actual inflation rate is being exaggerated by this statistical artifact.
But, sir, this time we are talking about El Nino and deficit monsoon. If that is the case, will RBI not consider this thing while working on the interest rates?
Yes, I think it's the fact that an El Nino is looking like a strong possibility. I mean, the U.S. Weather Service, which monitors the El Nino over the Pacific, says there's a 50% chance of an El Nino phenomenon this year. So if an El Nino does happen, then it is likely to affect the monsoon. A lot will depend on whether or not we get a lot of rain in June prior to the El Nino. El Nino typically sets in around July, August. Okay. So if the El Nino, a lot will depend on how much rainfall we have in June. If June is a good month of rainfall, then that will help. But the second half of the monsoon could well be negatively affected. Now, the last time we had an El Nino was 2015, and before that 2014 and 2015 were El Nino affected years, and we had below normal Kharif harvests in both years. Well, we had below normal rainfall in both years, but the Kharif harvest was actually only moderately below, only slightly lower. Okay. And inflation in 2014-15 was quite well contained. Now, the issue this time, I think, is that the granaries of the FCI may be somewhat depleted from the distribution of free food grain. Remember, the free food grain is going to be continuing to be distributed right through this year, from January to December. So there will be, I think, some slightly negative impact on the Kharif harvest. But whether there'll be much of a negative impact on inflation is debatable. I think that there'll be some impact on food inflation, but nothing that is too much worse than we have currently. That's one aspect. The other aspect is that over the next 6 months, fuel prices are going to be a lot lower year on year. Starting from the March number, we're going to start seeing fuel and transport costs down year on year, simply from the fact that there's a very high base. The Brent crude price averaged $111 a barrel between March and August last year. That was, the immediate period after the Russo-Ukrainian war began, and so we have we're going to get positive impact. So I think that there is, in the next 5 or 6 months, we'll have a relatively benign inflation environment. But the period after about September onwards, depending on how bad the El Nino effect is, there'll need to be some vigil. And, there's the potential for the RBI to have to act against inflation at the wrong time of the year, at a time when most of the rest of the world will not be doing very much because the Western world is likely to be in recession, and their inflation fights would be won for them not by their central banks but by their economies being in recession.
Mr. Basu, what is cooking between China and Russia?
Well, what is cooking is very simple. I mean, the United States has pushed Russia into China's arms, and and there's a pun there, of course, with arms. So what's happening there is that Russia is running out of friends at this point. It is fighting a difficult war in Ukraine, and the one friend that it can rely upon is China, and of course, to some degree, India as well. Now, the ironic aspect is that Russia and China are rivals for influence in Central Asia, in Kazakhstan, Kyrgyzstan, Tajikistan, Turkmenistan, etc. China is gradually displacing Russia as the main source of arms, of funding for infrastructure, etc. And so, ironically, Russia and China are rivals in that region, but at this point, Russia is losing ground to China. But on the other hand, Russia has to embrace China because it's the only country among the P5 willing to provide it support in the UN Security Council and elsewhere. And so that relationship is getting deeper, and at the same time, of course, China is working towards improving its role as a mediator in disputes in West Asia, where it's recently worked out a deal between Saudi Arabia and Iran to restore diplomatic ties between the two estranged neighbors. And so, China is gaining a bit of ground diplomatically, while the US is still engaged basically in fighting Russia through Ukraine as a proxy. And that is a bit unfortunate, I think. From our perspective, India is a US ally, and Russia is an ally of India, particularly in terms of the supply of arms. And India is one of the few places to which Russia is able to ship its oil and gas, which actually is quite convenient for the rest of the world, because India then processes that oil and gas and exports the refined petroleum to Western Europe and the US. So there is this strange global situation that we are now facing. But you've got Russia and China getting closer. There's no question that that is a bad thing from the long-term perspective for the US and also for India.
Mr. Basu, the crisis that we are seeing in the US, as far as the banking crisis are concerned, what is the kind of impact that you see on the startup ecosystem in India? Because many of the startups in India have exposures to these banks, and they might also be not able to raise the capital so easily now.
Well, actually, no. The primary funding for for startups in India as well as in Silicon Valley in the United States comes not from the banks, but from venture capital and private equity firms. And the interesting thing is that these venture capital and private equity firms were, in fact, the depositors in Silicon Valley Bank.
Yeah.
And one of the controversies in the US right now is about the Biden administration effectively bailing out all the depositors. There is a limit of $250,000 per depositor on the amount of deposits that are insured in each bank. So if you have in the US, if you have 250,000 of deposits in one bank, that is insured by the Federal Deposit Insurance Corporation, FDIC. Anything beyond 250,000 is not insured. But the Biden administration, the US Treasury has basically announced that all depositors in Silicon Valley Bank will be made whole. That means they're not going to suffer any losses, despite Silicon Valley Bank being in so much trouble. So, in effect, what that means is that the venture capitalists and the private equity players are safe. Their money is not going away. So, yeah, they'll be a little more cautious going forward, but they'll continue to be able to have capital available to invest in startups. I don't think there's any real change in the startup ecosystem as a consequence of the collapse of Silicon Valley Bank or any other bank, because the banks are typically not the funders. They aren't lending. One of the reasons why SVB got into trouble is because it wasn't lending very much. The problem with Silicon Valley Bank is that it had much higher deposits than loans. It didn't have enough avenues to lend the money out. And because it didn't have avenues to lend the money out, they bought mortgage-backed securities and long-term government bonds. And that's where that's how they got into trouble, not through their lending.
I have a question in mind, Mr. Basu. Isn't it poor treasury management by these banks which are shutting shops in US? Because interest rates have been started to go up from last 10 months. I mean, they would have enough time to really look at their treasury risk management, right?
Yeah. Well, interest rates began to go up exactly a year ago in the US. And, they could have, the point is that Treasury, by definition, you should be invested in short-term securities. If you've invested money market funds in Treasury bills and other liquid instruments, you won't get into trouble. The problem with Silicon Valley Bank is that it didn't invest in what is typical, what they should normally do, which is keep their duration low. They went for high duration, longer duration assets. They bought things like 30-year Treasury bonds. They bought mortgage-backed securities. Now, some of these things can be sold off. So when they start seeing interest rates going up, they could have tried to sell immediately and made fairly small losses. But they waited until January, by which time the value of that asset portfolio had declined very substantially, and then they tried to sell. So it was actually a kind of a panic selling, which led to big losses, of course, and that is what caused the problem. So yes, poor treasury management. I mean, it's not so much poor treasury management, really. Basic banking, 101. When you take a banking course, the first thing you'll be taught is to manage the asset liability portfolio, make sure that there's no mismatch, either a duration mismatch or a currency mismatch between your assets and your liabilities. And if there is a duration mismatch, you need to find ways of hedging that out, of securitizing some of your assets and getting rid of them, selling them off. You don't hold the risk on your books. So there are these are very basic things that bank managements know, But unfortunately, Silicon Valley Bank's management clearly did not adhere to some basic principles.
Now let's take a few questions which have come to us on our YouTube channel. But before that, I would remind my viewers to please do subscribe to our YouTube channel. And if you like this webinar, please do share with your friends. First question is from Deepankar, and his question is a rate increase the only lever for central banks to tame inflation?
Well, it is. I mean, in terms of taming inflation, there aren't too many other levers. I mean, the basic lever is a change in interest rates, or, which amounts to the same thing, a shrinkage in the money supply. So the problem in the US is, as I've said on many of these monthly events in the past, the basic problem is that the US had very rapid monetary growth. M2 money supply was growing at an average pace year on year of 18.2% for 2 years, from March 2020 to February 2022. If you go back in history over the last 85 years, you'll find that the average M2 money supply growth in the US was only around 7%. So compared to 7% growth, that was the average pace in the past, they had far more rapid growth. So what is happening now is that the Fed is actually shrinking the monetary base, and as a result, money supply is also finally shrinking for the first time in at least 80 years. So that's happening, but you need more shrinkage of money supply in order to bring inflation down. And part of that, of course, means that you'll have to also raise interest rates in the process, which amounts to the same thing. It's either you shrink the money supply or you raise interest rates directly. Either of those two things amounts to pretty much the same thing. But there are no other real means at a central bank's disposal. Of course, there is something at the disposal of the government. The government can reduce its spending. It could sharply reduce spending, or it could raise taxes. So that's a fiscal. Those are fiscal measures to reduce aggregate demand. But in terms of central bank, it's really the interest rate.
One more question I have is the kind of bailouts that we're seeing in US. Isn't it a kind of quantitative easing?
Well, in some ways, the fact that the central bank has made a certain amount of liquidity support available to all banks is a potential form of quantitative easing, but it's not quantitative easing. It is just a form of monetary creation. Now, quantitative easing is basically the specific term refers to the government, the central bank buying a lot of bonds from the public. So when it buys bonds, mortgage-backed securities, and other asset-backed securities from the market, and creates money directly by doing so, that generally refers to quantitative easing. So at the moment, Fed is actually going through quantitative tightening. It is buying back. It's now selling some of the securities that it had bought in the past. So it's selling them, and when the central bank sells anything, that shrinks the monetary base. So they're shrinking the bank. That creates new money, and in fact, that is a form of easing. So you have that easing going on, but at the same time, most likely, what the Fed will do to keep the federal funds rate at the level they want, they lend money to the banks that need it, thereby creating new money. And at the same time, they will increase the amount of quantitative tightening by selling down more of their portfolio of government securities. So the net effect will be offset.
Okay. Second question I'll take. How do the periodic weather phenomenon of El Nino and La Nino impact various sectors in the market? And which industries are most vulnerable to these effects?
Well, La Nina is currently on, by the way. We currently have a La Nina on, which basically means that conditions over the Pacific Ocean are relatively colder than normal, and as a result, we are seeing some rain. You may have noticed that in North India, there's been an unusual burst of rain over the past week. Actually, if you look at March weather conditions, we had an unusual dry spell for 15 days. Normally, I just looked it up actually today. Normally, in the month of March, you get about 27 millimeters of rain on average across India. This year, until now, we've had 22 millimeters of rain so far, and most of that has occurred in the last 1 week. So it seems as if we've had a very wet period over the last 1 week in North India, but it's actually making up for the deficit. Now, the specific question was what sectors, what types of stocks benefit or suffer from El Niños. Now, El Nino is the opposite of a La Nina. What is supposed to happen is that around July, August this year, there's 50% probability that an El Nino will form, which means that water over the Pacific will be a little bit warmer than normal. As a result, you'll get drier conditions on the coast of the Pacific Ocean, because it's a huge ocean. So across Asia and all the way to India, you'll see some drier conditions, and those drier conditions will have an impact on the monsoon. So the key sufferers from an El Nino typically would be the farm sector, the agriculture sector, and those selling into it. So tractor manufacturers, for instance, would suffer, that's one clear impact. Grain distributors and so on, those who handle grain would suffer. Traders. So you'll see some negative impact on that segment. But broadly, my experience of El Niños and their impact on the Indian economy over the last 10 years has been that the Indian economy has weathered El Niños relatively well. 2014, 2015, if you remember, were not bad years for the economy. The economy did quite well. It actually accelerated to 7 to 8% growth in those 2 years. So, in effect, the rest of the economy pick up some of the slack. So, if we have a pickup in investment spending of the sort that was already beginning to occur in India, and that continues into the next fiscal year.
It's time to wrap up the show. Thanks for watching. Please do subscribe to our YouTube channel, and please do post your queries in the comment section below, and we'll surely take it in our next episode. And let us know any other topic that you want us to take up for this webinar. And if you really like this webinar, please do share it on your social media platforms. Thank you so much for watching. Till we meet next month with Mr. Basu, we'll try and get into more details about how Indian economy is going to fare in times to come.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.